I want to start off, as I do each week, kind of with a summary of what I saw happening with the market. And as you know, I put out a video, Monday through Thursday, just about the market and what's going on. And then on Fridays, I try to do a summary. And so this is the market, going back to the 2018 timeframe, and we can see, kind of what's been going on. This week, market looks like it might be down a little bit in the end.
A little bit.
And really, if you look at the overall trend, though, it's very strong, really good markets altogether. We're coming off an all-time high from last week, and October can be kind of a rocky time frame. We're heading into election. And again, I've mentioned before, election, presidential election years, we generally have some softness in that 60 days prior. My personal opinion is people want to see what the results are going to be, if they're going to make bets one way or another, depending on, what the makeup is, the White House and Congress, as to what direction you might want to go. And so tends to be very good after the election. So we'll see what happens this time. It's one of those things that so many people are talking about. Sometimes you wonder if that's going to be true, get so many people on one side. Nonetheless, the fundamentals are there. The market is still doing pretty well. Earnings are, continuing to come through. And then today, of course, we got a big surprising jobs report. This is a big report right now because the mandate for the Federal Reserve is a dual mandate. Full employment, which is around 4%. Unemployment today dropped from 4.2 to 4.1. That's within their range of what they're looking at in terms of full employment. And then the number of jobs created, I think it was about 170,000 was expected, and 245,000 is what we ended up with.
Yeah, it was a really big surprise to the upside, and they revised the previous months up too.
Yeah, that's kind of interesting because that's been kind of controversial. Earlier in the summer they revised, which is what these things are constantly being revised, and they revised down a lot of the months from earlier this year. Today they revised up a couple of the months, and then of course today's jobs report was quite good. And the last couple of months we've had a couple of big drop-offs after the jobs report.
Yeah,
also
the first week of the last 2 months have been kind of weak following the job report.
Yeah, and so again, if you just look at the basics, if you look at the gross domestic product, if you look at earnings, they're doing well. And so you can't have a terrible job market and have those types of scenarios. Yet consumer spending is going okay. And so whether they tell us the right numbers at the right times or whatever, you can see in other ways kind of what's going on and how the markets are working as far as that goes. And so I want to switch to talking about a little something different here. Can we move the Chiron out of there? I'm going to push this and watch this. So here we go, putting a little, whoops. Oh, it's not working again. Thank you. So what I was trying to do is put that little arrow in there. And so that arrow represents the first video that I did. Okay, March 22nd, 2020. I sat down and did a video with the express purpose of trying to point out what was positive. Because here's the thing, at that time, the market's dropping faster than it's ever fallen before. We hit the fastest 35% drop in history. And so I have clients that are obviously worried about their financial, but they're also worried about health. We had this dual kind of physical and financial fear going on. And I was just trying to point out, what was positive at that time. And that's been the main concept of this whole show, of the videos that I do every day. And the reason is because you hardly ever see the positive news. It gets buried in the negative. And I don't want everybody, including myself, to be looking through everything with rose-colored glasses, because you can get burned that way too. You have to have some balance. And what I was sensing, especially then and even today, is the balance is still on the negative. People still feel that, oh, this is going to happen or that's going to happen. They're always waiting for the other shoe to drop. And in the end, if you look at where that arrow is and you look at what would have been the better thing to focus on, positive or negative, all right, the market is up almost 150% from where that arrow is at the bottom there. So it obviously would have been better to focus on the positive, and rose-colored glasses would have paid off quite well in this particular scenario. However, again, I'm going to present something today that came up this week that I thought was pretty interesting, and I bet a lot of people didn't hear about it or see it. And again, it's because we're worried about the Middle East, or we're worried about the election, or worried about all these things, and a lot of them can be kind of negative. and it kind of crowds out that positive. And so that's what we're here for. And so UBS, all right, so UBS is one of the largest wealth management firms in the world. They have $3.1 trillion under management. Guess who's the largest?
Is it Black?
Nope, not for a wealth
Oh.
advisor firm. Yeah, BlackRock is the largest, asset management firm. Charles Schwab, 9.1 trillion. Nonetheless, UBS had a report today, this week, sorry, coming out saying, is the U.S. economy set for another roaring 20s? Okay, so here we are in the 20s. Can we have another roaring 20s? Now, what's interesting about this is one of the things about halfway through 2020 when the market started to really come back and all the way through 2021, I kept talking about the last time we had a pandemic, it was followed by a very strong stock market. It just took a while for it to really take off and for everything to come into play. And we ended up with this big run up. And so I just think it was kind of interesting to see what's going on. And so here's the criteria that they have for officially declaring the 2020s a roaring 20s. Gross domestic product of 2.5% or higher. Check. All right, we're at 3% gross domestic product for annualized for the last quarter. Good. Inflation of 2 to 3% range. Check. Right, we're there at this point in time. Fed funds rate around 3.5%. Not quite. We're at 4.75 to 5. Right. So we got a ways to go, but we are hopefully still trending downward. We might be able to get to that. 10-year Treasury yield around 4%. Well, with today's big jobs report, actually the Treasury yield jumped up to almost 4%.
Yeah,
so
close.
It's another check. So we're really close. As a matter of fact, one of them we're on the way, most likely. Now, one of the things that they're talking about here is that they say this is their best case scenario. A lot of these companies present, here's our bull case, here's our bear case, here's our neutral case, those type of things. But they did say that this is the one that they have at a 50% likelihood of happening. Which I thought was quite interesting. And so, they've got they said that there needs to be some push and some what they call megatrends. So they've identified these 4 megatrends. A capital spending boom could occur, right? So what's happening with labor costs growing, you're getting a lot more automation, you're getting, a lot of money being spent on that. The infrastructure in the capital is still, it's aging, and so, replacing that. And then enormous investment required to transition to green energy, right? So as that continues, we're seeing, that be a possible mega trend. Focus on security and deglobalization. I actually find this one to be the most interesting because what happened during the pandemic, we realized, we need to be able to make some stuff, onshore. They call it onshoring, right? So, now we've got these big bills that are coming out to try to deal with semiconductor, which is a big one, here in the U.S., and they're going to continue to do that. That's a massive spend that's going to happen to kind of do that. Of course, and they call it, friendly countries that you might, still work with and all these different things. It's very interesting to see how that's
there's a
playing
shift to
out.
more being on the same continent.
Yes.
Even if it's not your same country, you could be like, for U.S., manufacturing in Canada or Mexico.
Right.
Instead.
Exactly. And so that takes money. That money comes in, it gets spent, it stimulates the economy, it creates, a good stock market. So then, of course, the investments in artificial intelligence are expected to rise. So those are the 4 big mega trends that they're looking at that could propel us into that kind of roaring 20s concept, okay? And so I just think it's very fascinating. Again, keeping our eyes, on, some positive news. I would again bet that not a lot of people saw this report. It came out in Forbes, so they wrote about it. It again gets buried in all of these other things that have been going on at this point in time. But I think it's very important to look at this because, yes, we're up 150% since kind of started these videos by chance. But who says we can't be up another 150%? So just having that balance, having that positive thought process to go along with all the negative things, because all the time clients are sending me emails that they're getting that everything's going to collapse, and all the time, all the way through that 150% raise, I've had clients sending me negative emails. And why do they send those negative emails? Because people respond to fear more than they do to other things like greed
Yeah,
or
fear is the number one,
Yeah.
like emotional response.
It's why the stock markets go up slowly and down quickly. It's the fear is much stronger. Okay, so here's a very long-term chart going back to 1881. This is a combination of the Dow and the S&P, and this is TradingView. They make this one chart. I think it's kind of interesting. Where I have that arrow, that's the Roaring Twenties, right? So you could say the bottom was about 1921, and of course the end of it was 1929. So it was like an 8-year run altogether. Unbelievable run. I mean, straight up. As a matter of fact, it's probably on an 8-year basis. I'd challenge somebody to find a better 8 years. The best 5 years, we can see just above me here, was the 95 to 2000 a run that happened for the .com. But in terms of an 8-year run, that's a big one. Of course, it was followed by that big downturn. And so let's just talk about that for a minute. Again, kind of balancing out our thought process. Number one, we might be, if this comes out to be somewhat accurate, in the run of this, not at the end of it, but there will be an end to it at some point. And oftentimes these things create these bubbles that then pop, right? And back in the Great Depression and the Roaring 20 timeframes, a lot of people were using margin to buy stocks. It was very common, and the margin requirement was only 10%.
Yeah.
So you could buy $100,000 worth of stocks for $10,000, right? So I don't have a single client that uses margin. I think one thing we've learned about margin is that it's
dangerous.
It's dangerous. It's not for the everyday thing. As a matter of fact, the Dow Jones was a lot more like Bitcoin at the time, in terms of its volatility.
Yeah, it was Wild West kind of.
Yeah,
It was
yeah.
in infancy. But now you can kind of see it's moved to options. There's a little bit more.
That's right, and that's where you're getting some of the leveraging concepts and what have you. So it's still out there, and people do it. It's just not my clients. But what happens at kind of the dichotomy of these bubbles is similar. You start to see, like, for example, next year we should start to see an IPO market form. It should start to have more IPOs. Eventually the IPO market will get crazier and crazier, like it did in the .com bubble, where we had things that came out without earnings and such. Because right now, there's a lot of artificial intelligence companies that could come public, but there's a lot of money in that space already, private money, so they don't really have to go public. And they don't all have earnings yet, that kind of thing. At some point in time, as the things develop, that dichotomy, they won't have to have earnings to go public. That's what happened in the .com. So those are things we kind of watch for. What kind of craziness is going on? Even in the 2021 run-up, we ended up with those SPACs, right, which I thought were really nuts and turned out to not work out very well. So those are some of the clues that we'll be watching for throughout this run. We're not there yet. We're not seeing that. We don't even have an IPO market of any substance, at this point in time. I do think, and I've been saying this for a little while, I think 2025 is the year that the IPO market could kind of start to go. And there's got to be a whole bunch of IPOs sitting out there waiting to go, just because there hasn't been many done for a while. So the other part is you should have some type of a process in place so that you're not going to ride through the end of that bubble, which in this case was an 87% stock market drop during that Great Depression. So some rotational concept where you can stay in for as much as you can, like last year's 10% drop, you can stay in for that. But when it starts to get worse and worse, you have some capability of being able to get a bit more conservative and kind of wait. Preserve some capital and wait and then come through. So anyway, I don't disagree with what they're talking about in this article. Matter of fact, it's something I talked about, in prior years. And I just want to, continue to focus on, what some of the possibilities are here because things are much better than people seem to know. I mean, if you interview the average person, they think the economy's, not doing well. It's actually doing very well. And so, that's partly what's happening. Now, this is last week's bet on what was going to happen with the Fed funds rate at the November 7th meeting. It was actually 57% said a half a point rate cut.
Yep.
Right? Now, okay, after 1 week, we're now at a 97% chance of a quarter
cut.
Right, rate cut, and 3% chance of no rate cut. And that's because the reports that have come out have shown a lot of strength, so especially this jobs report today. Because just in one day, it went from 32% chance of a 50% drop to zero based on this one report. So not all that important. it's just kind of interesting. It just shows that we have a chance for this soft landing or no landing scenario where we keep going along, even though they raised rates so much that it should have caused a recession.
Yeah, so you have a slowdown, but you just don't have actual negative growth.
Yeah, exactly. And who knows where we might end up with all of that. But I will say again, the key thing that happened, the reason that Wall Street was so dead wrong last year was unbelievable. How many articles and major players in major places talking about huge drops, 20% more or drops in the stock market in 2023, because when you raise rates 5.25% really quickly, like the Fed did, you get a recession. I agree. However, not during a pandemic, because what happened for the pandemic was so much money was pushed out the door, and then you ended up with kind of a trapped population that then got freed and
Yeah.
they're out spending money and traveling. And I do think that stuff is normalizing out now, the travel, just talking to clients and reading articles and looking at things. And I think the pent up demand portion is kind of settling down, but we have these other four mega trends coming in: capital expenditures, the green energy, the deglobalization. That's still going, right?
Mm-hmm.
I mean, that's going to take a long time. It'll go for 20 years based off of this pandemic that just happened. And et cetera. So that and artificial intelligence is just really icing on the cake. It's not the only thing out there that's pushing all of this. And so I don't know. I think that again, focusing on what's going on that is positive has some benefits to making us all more balanced investors. It's really easy to fill out the negative side of a chart, so to speak. It's a lot more difficult to find all the positives to put down on that side to get that balance. So that's what we'll continue to try to provide with these. So I want to thank everybody very much for listening to our summary this week, and again we'll look at doing this again next week. So.